Chapter 12, Responsibility Accounting, Operational Performance Measures, and the Balanced Scorecard, by Melissa and Max. Objective 1. Explain the role of responsibility accounting in fostering goal congruence. In order to establish an appropriate division of labor within an organization, most divide themselves into various subunits or departments. Although organizations consist of a variety of divisions, they all strive to achieve the goals instituted by top management. This endeavor to reach and exceed desired goals is called goal congruence. To encourage this, managers use various concepts and tools to measure the performance of employees and departments. The utilization of these concepts and tools is called responsibility accounting. Objective 2. Define and give an example of a cost center, a revenue center, a profit center, and an investment center. A responsibility center is a subunit in an organization whose manager is held accountable for specified financial results. Classifying each department within an organization as a specific one is the foundation of responsibility accounting. 4 common types exist: cost centers, revenue centers, profit centers, and investment centers. Cost centers. A cost center is a segment of an organization whose manager is held accountable for costs incurred. The center does not directly add profit, however, its operations still incur expenses for the organization. An example would be the painting department in an automobile plant. Revenue centers. This is a segment of an organization whose manager is held accountable for the revenue generated by the subunit. An example would be the advertising sales department of a mobile app developer. Profit center. This is a segment of an organization whose manager is held accountable for the profit, revenue, and expenses generated by the subunit. An example would be a company-owned restaurant in a fast food chain. Investment centers. This is a segment of an organization whose manager is held accountable for the subunit's profit and the invested capital used by the subunit to generate its profit. The manager for an investment center also determines where to allocate profits within the organization. An example would be a small startup company. Objective 3. Prepare a performance report and explain the relationships between the performance reports for various responsibility centers. Managers can utilize a performance report, a financial document that summarizes the performance of each subdivision within an organization on a periodic basis. It displays the appropriate budgeted, actual, and variances between them for a particular responsibility center. This displacement of such financial data allows managers to visualize the performance of subdivisions within an organization relative to one another. Performance reports therefore aid managers in their investigation and analysis of variances. Remembering performance reports aid managers in improving the overall performance of an organization. They help managers motivate employees who have contributed to favorable variances and assist them in planning future operations. Objective 4. Use a cost allocation base to allocate costs. A significant function of responsibility accounting is the delegation of an organization's overall costs to the particular subunit that causes them to occur. Cost pool. A cost pool is a collection of costs to be assigned to their respective subunits. Cost objects. Cost objects are the responsibility centers, products, or services in which costs are to be assigned. Cost allocation. This is the process of delegating the costs within the cost pool to the cost objects. Allocation base. This is a measure of activity, physical or economic characteristic that is associated with the responsibility centers, which are the cost objects. An organization's managerial accountants select an allocation base for each cost pool. Activity-based responsibility accounting. Under this, management's attention is directed not only to the cost incurred in activity, but also to the activity itself. Behavioral ramifications. Responsibility accounting systems can substantially impact behavior within an organization. Information-free blame. When the responsibility accounting system's informational role is emphasized, managers tend to react constructively and strive for improved performance. Controllability. Performance reports can be used to distinguish between controllable and uncontrollable costs or revenues, and this provides managers with complete information regarding controllability of a particular aspect of the organization, and this in turn allows them to set their managerial priorities based on tractable influences.
created using Powtoon.